The sum of private consumption and private investment is called private demand. We say that private demand is crowded in if it increases in response to public investment scale-ups. On the other hand, we say private demand is crowded out if it decreases in response to public investment scale-ups. Notice that the crowded in and the crowding out effects on private demand depend on two opposing channels. Channel 1. The accumulation of more public capital makes private inputs, labor and private capital more productive, leads to more private investment, and if the increase in households' income is strong enough, more private consumption. In other words, this channel leads to higher private demand, the crowding in phenomenon. Channel 2. When the government recurs to issuing domestic debt, raises taxes, and/or cuts other expenditures to finance the public investment surge, there is a shift of resources from the private sector to the public sector. This leads to less private investment and consumption. In other words, private demand decreases. This is the crowding out phenomenon. Which effects dominates, crowding in versus crowding out, depends on several factors, but generally, in the first years, crowding out may dominate because the implied initial fiscal adjustment or increase in public domestic debt take resources from private agents. In the long run, if the projects are good, there is crowding in, because the higher stock of productive capital that takes time to build will sustain higher productivity and higher incomes, allowing in turn higher levels of private consumption and investment.